Does it ever strike you how central banks wield the power to influence economies? They are the unseen conductors orchestrating the symphony of financial markets. One of the most crucial instruments they have at their disposal is the seemingly innocuous concept of interest rates. Imagine interest rates as the price tag on borrowed money. It's the cost you pay for a loan, and conversely, what a bank pays you for your deposits. The central bank, acting as the bank for banks, sets the baseline interest rate that guides the broader financial system. Now, why would a central bank decide to hike these interest rates? The answer lies in their ongoing battle with an economic nemesis: inflation. Picture inflation as a relentless tide, eroding the value of money. Central banks like the Federal Reserve or the Bank of England aim to keep this tide at bay, targeting an inflation rate of around 2%. If inflation starts to surge beyond this, central banks may decide to raise interest rates, effectively hitting the economic brakes. However, this action sends ripples across the entire economic landscape. Borrowing becomes more expensive, potentially dampening consumer spending and business investment. On the flip side, savers might find themselves earning more on their deposits, yet the impacts are not evenly distributed. In places where fixed-rate mortgages are prevalent, such as the US and Canada, existing homeowners are somewhat shielded from immediate effects. But potential new buyers might be deterred by high rates, leading to potential drops in home prices and subsequent effects on wealth and spending. Central banks walk a tightrope when adjusting interest rates. Their objective is to keep inflation in check without strangling economic growth. It's a delicate balance, and history is littered with examples of how aggressive monetary tightening can lead to significant economic downturns. Yet some inflation is necessary for a healthy economy. It stimulates spending and investment rather than hoarding money. The challenge for central banks is to prevent inflation from spiraling into a vicious cycle where rising prices trigger higher wage demands, which in turn fuel further price increases. Central banks must often make decisions based on forecasts, adjusting rates today to counter inflation that may or may not materialize in the future. This forward-looking approach is complicated by the fact that the effects of interest rate changes can take time to fully materialize, often up to 2 years. In conclusion, while raising interest rates is a powerful tool for managing inflation, it's not without its downsides. It's a testament to the intricate balancing act central banks perform in their mission to foster economic stability. The world of central banks and interest rates is a complex dance, but understanding this dance is key to grasping the broader movements of the global economy.